Welcome to the Critical Point Podcast on the stock market. It is April 22nd, 9:18 a.m. Central Time, and we're using the mini S&P futures to discuss the overall U.S. stock market. Let's take a look at what the model is up to on a basing on a daily chart. And what we can see is the market rallied into the 50-day average and has pulled back. We can see it's starting to violate a tentative trend line of support. We can see the SAR technical indicator that did a fine job of buying on March 24th and sold yesterday, so it is now bearish. And we can see daily stochastic actually started turning bearish ahead of the top, paid no attention to that gap higher on the virus drug news. And the market then came down to fill that gap, but it continued to sell, so that's also bearish action. So we do have some action to lead us to believe that the model can be correct, that we've just recently seen an L3 top as of April 17th, and that it's the first opportunity, but perhaps ideal opportunity, for a more important level 2 top, meaning a level 2 is how we do business over a quarterly basis. It's the second most important type of sell signal during a year. And the forecast is that if it truly did top for the L2, then the trend is down into late May. Now, it's possible we're just going to see choppy trading range if back in March we placed a long-term bottom, okay, or at least a level 1 bottom, which is the most important type of bottom during a year. So bottom line is the trend should be down now, but we're seeing some decent support this morning. And this is off the news of the crude oil market coming back today. We finally got that horrible May futures contract expired that went to negative prices, and I understand it expired actually by turning slightly positive. So the bottom line is people are reflecting this morning. They're asking themselves, is it really time to put this market back down? Is it time to truly refocus on the bearish data that has never left? And there's more bearish data coming in terms of the economy, in terms of the impact of the virus, okay, that we're still in a recession. Citi this morning, the Citi group, I believe it is, came out this morning and said we're still in a bear market. You can still see lower values, and they're watching 4 primary inputs. They're watching the PMIs, which they believe in a few days here we will learn of the April flash PMI, and they believe it's going to crash from 48 to 38 or something like that. And that would signal we are in recession, if not deep recession. Getting close to 32 would be like a great recession that we saw back in 2008, 2009. Now, they're also watching, of course, the virus, and they're not convinced things are moving fast enough of actually conquering that. They're watching earnings per share, specifically the tail kind of estimates, and they said they're still too high. Analysts have still not caught up with the damage done by this virus-related recession. And then they're watching credit spreads, which they said has tightened, which is rather supportive for the bulls, but they cited a few factors going into those credit spreads where they're concerned that maybe they just widen again and could at least be temporarily negative. So those are some of the things to watch in the news here, and for headlines for the news cycle of how we could refocus or just swing that fundamental bias, the list of fundamentals, that bias from it, swing it back to the bear side a bit. Now, even though I'm trying to support some evidence here that the market's going lower into late May, and it's at least going lower into next week for a level 3 bottom, which is just your intra-month kind of fluctuations, the buyer or seller interest, I must say that the market's holding here pretty good this morning. It's up. And when we look at the intraday fluctuations and intra-week fluctuations, the model suggests the market can be supported to higher into the overnight market, if not into the day session tomorrow. So our 12-hour, perhaps 24-hour forecast is a bit supportive here. And what I'm concerned is it possible that a level 3 bottom was actually placed yesterday? If so, the market could rally over the next 2 weeks instead of going down into this next level 3. What that would mean is if it would take out the recent high, then they're going to eye, the bulls that is, are going to eye, and bears probably, are going to eye the 3,000 level on the S&P 500 futures and cash. That's where we have the 100 to 200-day average, and the 200-day average is probably the most important average that most of the trade is watching, okay? Now, keep in mind, however, the market has bumped its head on this 50-day average. It has rolled over, and I don't like two-bar or two-candle double bottoms. So, in other words, there's yesterday's low, and today's low was actually at that level or a little higher. And when you only see two time periods, two bars, I get concerned that that's just temporary. I don't like to trust it. Sometimes I even bet against it. So the point is, if you don't want to be bearish, if you don't think the model is right or that it's early, that's okay. But this starts taking out today's low, or yesterday, let's make it yesterday's low at 2717.25 for the June futures. I think that's a negative sign that it is more likely that this L3 bottom just does not matter. In other words, maybe it did occur on April 16th, or the model's warning that was too soon. But it just doesn't matter, and I want to go with the idea that it topped, and we want to give it some time here to trade lower. If we start seeing trade above yesterday's high at 2833.25, we have to be concerned something's wrong, but we really will not revise the forecast to bullish until it takes out the high of April here at 2885. See that taken out, we'll start considering it's going to run to 3,000. But anytime from now in the first week of May, we're still going to throw a dart to try to find this level 2 top. So I've given you some parameters to watch here, some price levels to watch. And even though I can see we could be a little early on this call, that we could see a little range trade hesitation, I'm still going to go with 2 out of 3 scenarios are bearish. All right, let's go ahead and zoom out to the next larger trend. And so here's our weekly chart. And we had a level 1 downtrend, bear market, also 3-year and 9-year minor and major long-term cycles down. Okay, recession time, but we get this, what may only be a knee-jerk reaction for those of you who are still long-term bearish. This is a level 2 rally, but it was impressive. Some people say if you go all the way back to 1987 and look at all the crashes, the market never made a 50% recovery, and this market did. So some of those bears are bowing out a little bit, saying, well, maybe that March low is going to hold as a floor, but maybe it can be retested and successfully tested, and then the bear market ends, or maybe the bear market has ended. At any rate, what we have is overbought weekly stochastic, so it's warning. The technical side is warning. The model can be correct for calling a level 2 top. And ideally, even though we said the top could occur week of April 13th all the way to the week of May 4th, we put in an extra target saying ideally it will top this week or next. And now we have a down week so far, so that's supporting that idea that maybe it is topping at the ideal time. Now, if it takes out last week's low at 2711, which I want to check on this, hasn't done it yet, that would be additional evidence that the L2 top has occurred. Now again, we could get some kind of knee-jerk reaction or one last rally here and then down, so I want to watch out for that. But ideally, it's swinging lower into a bottom due week of May 18th to as late as week of June 15th. I'm leaning towards the bottom will occur in May, latter half May. We don't know how much of a retracement. You can use your Fibonacci retracements. Maybe it only comes back halfway, but I'm finding evidence to get close to 2,500. Now, for those of you that are still long-term bearish, there is a possibility that maybe we're not going to get a long-term bottom to this summer or fall. There's other opportunities here. I've said this several times. So maybe we can get a sizable decline even in this L2 or later in the year. And there's also a possibility, I think it's only 30% probability, but this was not a level 1 bottom back in March, it's level 2. If that's the case, ideally the market will be near that low and ideally lower by time of that latter half May, early June, and we'll just simply revise it and call it a level 1 and yet another opportunity for long term. So there's definitely reasons to consider. Maybe it's going to 2,000, 1,800, even as low as 1,300. It can be a crashing moment yet here. But right at the moment, I'm leaning with the idea there's a good chance we've already found a long-term bottom. It's just going to be very, very slow to develop a bull market, and a good chance this is only going to retrace to 2,500. But let's make sure we don't become overly optimistic here. There could be plenty more downside yet to come. For the moment, we need lower weekly closes here to turn this indicator to kind of give us additional evidence here of a sell signal. Until we see the April high taken out, I've got to remain bearish here, but I can see where this market may give us some problems here for a few more days before it wants to get going on the downside. As always, manage your risk relative to others. Thank you.